1. Start with energy, explain with authority, highlight with emphasis, end with warmth. Current market data reveals that Nuburu Inc. is trading right now at exactly 23 cents, showing a robust upward move of roughly 2.3 cents or 11.3% for the intraday session. While seeing a stock trade for less than the cost of a gunball might initially trigger a dismissive reaction from seasoned investors, the reality of this price action is far more complex and potentially explosive than a simple penny stock label suggests. The expectation for a company trading at 23 cents, specifically one that has battled delisting notices and severe liquidity crunches, is that it is a dead stock walking, a zombie equity waiting for the final nail in the coffin. Most analysts and casual observers looking at the chart expect a slow bleed into bankruptcy. However, the reality you are seeing on the tape today contradicts that terminal diagnosis. This 11% surge is not just random noise. It is a heartbeat. It represents a violent repricing of probability, specifically the probability that Nuburu's aggressive pivot from a pure-play laser component manufacturer to a diversified defense technology hub is actually gaining traction. We are witnessing a struggle between the delisting narrative and the defense contractor rebirth narrative, and right now, the rebirth story is winning the day. To understand why this stock is moving, we have to look at the volume and the specific nature of the buying. This isn't just retail traders throwing lunch money at a lottery ticket on their Robinhood app. There is a structural shift happening. The expectation was that Nuburu's cash burn would suffocate it before 2025 ended. The reality is that recent strategic maneuvers, specifically the capital raises and the acquisition spree involving entities like Orbit and the partnership with Tekne, have extended the runway just enough to keep the dream alive. When you see a stock of this size jump double digits on a Tuesday, it often signals that someone knows something about the integration of these new assets. For those monitoring Interactive Brokers stock trading data, the order flow shows a mix of high-frequency scalping and accumulation by risk-tolerant accounts who see the asymmetric upside. If this company survives, it doesn't just go to 25 cents, the thesis is that it potentially re-rates to dollars. Let's talk about the technology because that is the foundation of this entire speculative house of cards. Nuburu is not making generic laser pointers. They specialize in high-power blue laser technology. The expectation from the market has been that lasers are a commodity. The reality is that blue lasers are physically superior for welding conductive metals like copper and gold, materials that are the bloodline of the electric vehicle and AI revolution. Traditional infrared lasers struggle with copper. They bounce off it. Blue lasers are absorbed. This makes Nuburu's tech critical for battery manufacturing. When you think about Tesla stock and the massive demand for efficient battery production, or Nvidia stock and the need for precise manufacturing of heat sinks and electronic components, Nuburu's tech is theoretically sitting right in the sweet spot of that supply chain. The disconnect and the opportunity lies in the fact that while their tech is space age, their balance sheet has been stone age. The market loves the laser but hates the bank account. Today's move suggests that perhaps the bank account is becoming slightly less terrifying, allowing the value of the laser to shine through. For investors using Schwab Intelligent Portfolios or seeking investment help through traditional channels, a stock like Nuburu is likely uninvestable due to minimum price requirements and volatility rules. However, for the self-directed trader using Fidelity brokerage services or engaging in self-investing on platforms that allow for high-risk assets, this is a classic turnaround or bust play. The recent news cycle has been dominated by their shift toward defense. The expectation was that they would just sell lasers to factories. The reality is they are pivoting to become a defense tech platform. The acquisition of Orbit, focused on operational resilience software, and the alliance with Maddox Defense, drones, changes the complexion of the company. They are trying to package their laser tech into weapon systems and defense infrastructure. Defense contracts are sticky, they are long-term, and they are government-backed. If Nuburu can secure even a fraction of a Department of Defense program, the revenue visibility changes overnight. This 11% move reflects the market sniffing out the potential for these defense synergies to materialize sooner than expected. Let's look closer at the mechanics of the trade today. The stock is bouncing off a very low base. When a stock is at 23 cents, a 1-cent move is nearly 5%. This extreme leverage attracts a specific type of volume. We are seeing activity that aligns with momentum algorithms often used by traders on SoFi active investing platforms. These algorithms don't care about the fundamentals. They care about the slope of the line. And right now, the slope is positive. But beyond the algos, there is a fundamental argument being made by the buyers. They are looking at the market cap, which is microscopic, and comparing it to the replacement value of the IP, intellectual property. To develop high-power blue laser tech from scratch would cost hundreds of millions of dollars and take years. Nuburu has already done it. The market cap is currently trading at a fraction of that R&D spend. This deep value thesis is what keeps the floor under the price, preventing it from going to zero even when the cash flow looks grim. However, we must address the elephant in the room, the financial health. The most recent earnings reports were difficult to read. The expectation was bad, the reality was arguably worse in terms of cash bleed. They reported significant net losses and a substantial doubt regarding their ability to continue as a going concern. This is the standard legal language for "we might run out of money." This is why the stock is at 23 cents. For those of you managing Fidelity IRAs or looking for safe Fidelity mutual funds, this is the red flag that keeps you away. But for the distress investor, this going concern warning is the signal. It means the stock is priced for death. If they survive, through a new capital raise, a government grant, or a strategic buyout, the repricing is violent, as we are seeing today. The $12 million public offering in September was a lifeline. It diluted existing shareholders, yes, which is why the chart looks like a ski slope from earlier in the year, but it put cash in the bank. In the world of distressed equities, dilution is the tax you pay for survival. I want you to pause and assess your own position here. Comment below how many shares of Nuburu you are holding right now. Are you one of the brave souls who bought in at the dollar level and are averaging down, or are you a sniper who just entered at 20 cents? And critically, do you believe the defense pivot is real, or is it just management throwing spaghetti at the wall? The relationship with entities like Tekne is particularly interesting. The recent news about funding moving through the Supply@Me platform to Tekne, facilitated by Nuburu, shows a complex web of financial and operational entanglements. This isn't just a customer-vendor relationship, it's a strategic ecosystem. Nuburu is trying to build a coalition. The market often struggles to price these complex partnerships immediately, which leads to delayed reactions. The spike today could be a delayed digestion of the renewed partnership news from earlier this month. It takes time for retail investors on investing sites and forums to connect the dots between a press release and the revenue potential. We are also seeing a dual CEO structure now designed to drive this transformation. While dual CEOs can sometimes signal confusion, in this case it seems to be a division of labor. One focuses on the tech, the other on the financial engineering and M&A. If you are trading this on Interactive Brokers platform or checking your Fidelity mobile app, you need to be aware of the delisting clock. The NYSE American Exchange has rules. If a stock trades too low for too long, it gets kicked off. Nuburu has been fighting this battle for months. They have executed reverse splits in the past, and the threat of another one hangs over the stock. A reverse split is usually negative. It signals weakness. However, if the stock can organically climb back above the compliance threshold, it removes that overhang. Today's 11% move is a step toward that organic recovery. Every day it closes green is a day the short sellers who are betting on delisting get a little more nervous. The cost to borrow shares on stocks like this can be astronomical, sometimes exceeding 100% annually. This creates a powder keg dynamic where a small move up forces shorts to cover, creating a loop of buying. Let's zoom out to the broader industry context. We are in a period where hard tech and defense tech are attracting massive capital. Silicon Valley is moving away from pure software and back to building things: drones, robots, lasers. Nuburu sits in this hard tech bucket. Unlike a software company that can scale infinitely with zero marginal cost, Nuburu has to build physical units. This is harder, but it builds a wider moat. It is hard to copy a blue laser factory. This defensive moat is why some long-term holders, perhaps those with a small allocation in their Fidelity Wealth Management speculative bucket, are holding on. They believe that eventually a larger player, maybe a defense prime like Lockheed or a tech giant, will acquire them. At this market cap, Nuburu is bite-sized for a major corporation. Future outlook? It is binary. There is no middle ground for Nuburu. In 12 months, this stock is trading at zero or effectively zero on the pink sheets, or it is trading at multiple dollars. The bull case relies on the defense hub strategy